Hello everyone, I hope that you all are fit and fine, and let me tell you that I am completely fine as well. In this video, we are going to quickly revise part 1 of the capital gains chapter for CA Intermediate Income Tax Examinations. And as usual, before beginning the revision, my humble request to you is to like this video, comment if you find this video helpful, subscribe to this channel dear if you have not already subscribed, and share it with your friends so that as many students as possible can get the benefit of this revision lecture series. So now without further ado, let us begin the revision. As usual, like any other head of income, even the capital gains head has a charging section and a computation section. The charging section is section 45 subsection 1 of the Income Tax Act, and it tells that capital gains is chargeable on transfer of capital asset in the year of transfer. So when does capital gain arise? When there is a transfer of a capital asset in the year of transfer. So now, firstly, let us discuss what is capital asset. Section 2 clause 14 defines a capital asset. Section 2 clause 14 defines a capital asset. Now, what is a capital asset? Capital asset is a property of any kind. Capital asset is a property of any kind. It can be movable, immovable, tangible, intangible, it does not matter. So a property of any kind, movable, immovable, tangible, intangible, whether or not connected with the business or profession, is called a capital asset. So all kinds of property are included in capital asset. However, there are 6 exceptions to capital asset. What are the exception? Exception number 1 is stock in trade. So if there is any stock in trade, consumable stores or raw materials that are held for business or profession, then that is an exception to capital asset. It means that stock will not be considered as capital asset. However, except B. Now what is B point? B point tells that if a foreign institutional investor or a FII is having any stock, okay, as securities, then such stock will also be considered as capital asset. That is why if any foreign institutional investor is having a security as per the SEBI guidelines, it will always be considered as a capital asset. Whether it is stock or not a stock, it does not matter. Now let us come to other exceptions to capital asset. Exception number 2 is personal effects. Sir, what is personal effect? Personal effect means any movable property of personal nature. Movable property, personal nature. However, for personal effect also there are 6 exception. Personal effect is itself a exception. For that also there are 6 more exception. It means it is exception to exception. It means whatever I am going to tell now, it is included in the meaning of capital asset. What are included? Answer is JAD pass. What is JAD pass? JAD pass means jewelry, archaeological collection, drawing, painting, any other work of art and sculptures. Tell once again, jewelry, archaeological collection, drawings, paintings, any other work of art and sculptures. All these 6 items will be called capital asset. Even though they are personal effect, still they will be called capital asset. Okay, next third exception. What is the third exception? Rural agricultural land. So rural agricultural land is exception to capital asset. It means it is not a capital asset. Hence, if a rural agricultural land is transferred, no capital gains will arise. Next, specified gold bonds, that are 6.5 gold bonds, 6.5% gold bonds 1977, 7% gold bonds 1980, National Defense Gold Bond 1980. These will not be considered as capital asset. Then special bearer bonds of 1991 will not be considered as capital asset. Next, if there is a gold deposit bond under Gold Deposit Scheme 1999 or Gold Monetization Scheme 2015, then such bonds also will not be called as capital asset. And also we will learn in income from other sources that interest received on Gold Monetization Scheme bond will be completely exempt. Then there is a new type of capital asset. What is the new type? That is unit linked insurance plan. So if a unit linked insurance plan is there on which on or after 1/2/2021, 1st of February 2021, if the premium paid per policy or aggregate of all policy combined during the year 2,50,000 or more, in such more than 2,50,000, in such case such unit linked insurance policy will also be considered as capital asset. So now let me summarize capital asset once again for you all. Very important definition karna. So what is a capital asset? A capital asset is a property of any kind, whether movable, immovable, tangible, intangible, whether or not connected with the business or profession. However, there are 6 exceptions. Exception number 1 is stock, consumable stores or raw materials used for business. Exception number 2 is personal effects. What is personal effects? Movable property of personal nature. However, there are 6 exceptions to personal effect. What are they? Jewelry, archaeological collection, drawing, painting, any other work of art and sculpture. So all these 6 items, even though they are personal effect, will be considered as capital asset. All the other personal effect will not be considered as capital asset. For example, if I am having a mobile phone for personal use, it is not a capital asset. I am having a car for personal use, it is not a capital asset. I am having a pen for personal use, this is not a capital asset. Then rural agricultural land is not a capital asset. Specified gold bonds, that is 6.5% gold bonds 1977, 7% gold bonds 1980, National Defense Gold Bond 1980 are not a capital asset. Special bearer bonds of 1991 will not be a capital asset. Gold deposit bond under gold deposit scheme 1999 and gold monetization scheme 2015 will not be called capital asset. Then if there is any security that is held by foreign institutional investor as per SEBI guidelines, it will always be called as capital asset. Okay. Then if there is a unit linked insurance policy on or after 1 February 2021, if the premium is more than 2,50,000 per policy or aggregate of all policy combined during the year, then such policy will be called capital asset. You get my point? So that is the definition of capital expenditure, capital asset. Now let us come to transfer. Sir, what is transfer? Transfer is defined under section 2 clause 47 of the Income Tax Act, where transfer includes sale, exchange, relinquishment. Relinquishment means what? To give up. Okay. And then extinguishment of any right, means any right is extinguished or given up and the right is given to some other person. For example, a license is transferred from one person to another person. This is called extinguishment of any right. Then compulsory acquisition is also transfer. So if government is coming and compulsorily acquiring the property of assessee, that will be called transfer. If capital asset is converted into stock in trade, it will be called transfer. Then even if possession of the property is given for a part performance of a contract, that will also be called transfer. A classic example is joint development agreement. Then if there is any transaction which is having the effect of transferring or enabling the enjoyment of immovable property, that is also called transfer. This point I linked it with the house property chapter, where we learned the deemed owner concept, in which I told you that if at all there is a apartment, that apartment is in the name of a cooperative society. The members are of the cooperative society will be the owner of the apartment. So when the member is transferring the membership from one person to another person, then the person who is receiving the membership will also receive the flat in the apartment. Correct? Hence, when the membership is transferred from one person to another person, it is also means that the flat is transferred from one person to another person. Hence, it will be called transfer. Okay. Then redemption of zero coupon bond. If zero coupon bond is redeemed, that also will be called transfer. So what are included in transfer? Sale, exchange, relinquishment, extinguishment of any right, compulsory acquisition, conversion of capital asset into stock in trade, then giving possession of the property in part performance of a contract, transaction having the effect of enabling or transferring the enjoyment of immovable property, and then redemption of zero coupon bond. So this is the transfer definition. However, now there are many transactions that are not regarded as transfer at all. It is given under section number 47. So whatever is given under section 47 will not be regarded as transfer. If it is not a transfer, no capital gains will arise. Okay. So now what are the section transaction? Number 1, full or partial partition of HUF. So if HUF or Hindu undivided family, if the property is partitioned, then the capital gains will not arise in the hands of HUF. Next, if there is any gift or irrevocable trust also, there will not be any transfer. However, if sweat equity shares or ESOPs or specified security are given from the employer to the employee, that will be called transfer. Okay. Then if holding company is giving to 100% Indian subsidiary company, it is not a transfer. Subsidiary company is giving to 100% Indian holding company, it is not a transfer. Amalgamating company is giving to Indian amalgamated company, then also it is not a transfer. Now what is amalgamation karna? Amalgamation is where one or more companies join together to form a new company, it is called amalgamation. What are the conditions for amalgamation as per Income Tax Act? Condition number 1, all the property of the amalgamating company should become the property of amalgamated company. All the liabilities of amalgamating company should become the liability of amalgamated company, and shareholders having at least 3/4 shareholding in the amalgamating company should get the share in amalgamated company. So from old company to new company. So when amalgamating company is transferring any asset to Indian amalgamated company, then it is not regarded as transfer. Next, if demerged company is transferring the asset to Indian resulting company, then also it is not regarded as transfer. Now what is demerger? Demerger means where one or more undertakings of a company is coming out of the company to form a new company. I gave you an example. For example, there is Titan company. Titan company is having three brands, correct? Titan, Fast Track and Tanishq. Let's say Tanishq is coming out of Titan to form a new company called Tanishq Limited. This is called demerger. This is called demerger. Now, when demerger is there, some conditions should be satisfied for it to be called as demerger as per the Income Tax Act. What are the condition? Condition number 1, the transfer should take place as a going concern. It means when the new company is coming out, that is when Tanishq Limited is coming out of Titan, then Tanishq Limited should be a going concern company. Means its business should continue normally. Okay, then all the property of the undertaking being demerged should become the property of the resulting company. All the liabilities of the undertaking being demerged should become the liabilities of the resulting company. The property and liability should be transferred at book value, not revalue. Okay. Then shareholders having at least 3/4 shareholding in the demerged undertaking should get the shareholding in the resulting company. If all these conditions are satisfied, then the transaction will be called demerger. And if demerged company is transferring the asset to Indian resulting company, then it is a transaction not regarded as transfer. Capital gains will not arise. Okay. Next, if shares are issued by resulting company when demerger took place. So see, listen here. Tanishq Limited will come out from Titan and form a new company. So old shareholders of Titan Limited will get the new shares of Tanishq Limited. When these old shares are converted to new shares, it is not called as transfer. Similarly, when shares are issued by amalgamated company, when amalgamation takes place. So when amalgamation is happening, old shareholders should quit their shares and they will get the new shares. This conversion from old shares to new shares will not be called as capital gain, or capital will not be called as transfer, and hence capital gain will not arise. Next, if there is any rupee denominated bond and if it is transferred outside India from one non-resident to another non-resident, then also capital gain will not arise because it is a transaction not regarded as transfer. If a government security is transferred from one non-resident to another non-resident outside India, then also it is a transaction not regarded as transfer. Next, if there is any sovereign gold bond issued by RBI, and if an individual is redeeming the sovereign gold bond, then such transaction will not be regarded as transfer. However, before the redemption, if individual is selling the bond to some other person, then it is very much transfer. Okay. Next, transferring jewelry, archaeological collection, drawing, painting, any other work of art, sculptures, photographs, etc. to National Museum, art gallery or public museum will not be considered as transfer. Next, if any bond, debenture stock or deposit certificate is converted into shares or debentures, then also it is not a transfer. Next, if preference shares are converted to equity shares, it is not a transfer. Next, if capital asset is transferred under reverse mortgage, then also it is not a transfer. What is reverse mortgage? Reverse mortgage is a system where a senior citizen is giving his house or his land and building to a bank to receive the money from the bank. The money can be received as a loan for up to 20 years also. It can be received as a monthly, quarterly or annual installment also. Okay. So when the senior citizen is giving the property to the bank, it is not regarded as transfer. Similarly, when the bank is giving money to the senior citizen, that entire money received by the senior citizen will be exempt under section 10 clause 43. However, later on, as I told you, if the bank will sell that property to someone else, then capital gain will arise normally. Okay. Next, listen here. If there is a consolidating scheme of mutual fund or consolidating plan of mutual fund, then also it is not regarded as transfer. However, you have to make sure that two or more equity plans should convert to form a new equity plan, or two or more debt plans should combine to form a new debt plan. Only then this will not be regarded as transfer. However, if there is any other case, like for example, if equity and debt are mixed together, then it will be regarded as transfer. You get my point? So all these transactions are transaction not regarded as transfer. There is one more transaction also which we learnt in section number 46, that is distribution of assets on liquidation by a company. That is also transaction not regarded as a transfer. It is discussed in section number 46. Okay, so now we are clear with the charging section. So charging section says that transfer of capital asset in the year of transfer, if it is done, then capital gains will arise. We learned what is capital asset, we learned what is transfer, we learned what are all the transactions that are not regarded as transfer. Now let us see the computation section. Computation section is given under section number 48 of the Income Tax Act. First and foremost, you have to be clear. Sir, who has to pay the capital gains? Answer is Kanna. The transferor has to pay the capital gain. So if I am transferring my capital asset to some other person, I will give the capital asset and I will get the money. Correct? So I am the person who have to pay tax under capital gains. The transferor will pay the tax under capital gains. Now how to compute the capital gain? Firstly, you have to take the full value of consideration, FVOC, full value of consideration. Full value of consideration is nothing but sale price. Sale price. Okay. Then from that you have to reduce the transfer expense. Transfer expense means what, Kana? Any expense that is relating to the transfer. So for example, if I am selling my building, I am giving some brokerage expense to the broker for the purpose of selling the building. In such case, this brokerage will be called transfer expenses. But be clear with one point, security transaction tax will not be allowed as transfer expense. Okay. Then after reducing the transfer expense, you will get the net consideration. From the net consideration, you have to reduce cost of acquisition or indexed cost of acquisition, cost of improvement or indexed cost of improvement. After doing this, you will find the short term or long term capital gain or capital loss. From that, you can reduce section 54 series exemption. Then finally, you will find the taxable capital gains. Okay. So first what you have to do, take the full value of consideration, reduce the transfer expense. After reducing transfer expense, you will get net consideration. From the net consideration, you have to reduce cost of acquisition or indexed cost of acquisition, cost of improvement or indexed cost of improvement. After that, you will get the short term or long term capital gain or capital loss. From that, you can reduce the 54 series exemption. You will find out the taxable capital gains. Fine. So now let us see all the concepts one by one. Firstly, let us discuss the full value of consideration. In full value of consideration, there is only one concept, that is the concept of specified security. See here, in case of sweat equity or ESOP given to the employee, full value of consideration should be taken as fair market value on the date of transfer. So when the employer is giving the ESOP to the employee, then capital gains will arise in the hands of employer. For calculating such capital gain, full value of consideration should be taken as fair market value of the shares that are given to the employee on the date of exercise. Okay. Then I also told you, when the employee is receiving the shares, he has to pay tax under perquisite calculation under salary head of income. Correct. And further, when the employee is transferring the shares to some other person, then the cost also will be that fair market value only. I hope that you are all able to recollect, and as and when we are discussing, we will also discuss all those points. So full value of consideration we discussed. After that, we have to discuss about cost of acquisition, indexed cost of acquisition, cost of improvement or indexed cost of improvement. But before knowing about indexation and everything, we have to know the concept of period of holding. So let us see the concept of period of holding. Sir, what is period of holding? Period of holding means period starting from the date of acquisition till the date of transfer. Date of acquisition till date of transfer. So when I purchase the asset till the time when I sell the asset, that entire time period will be called as period of holding. However, period of holding can be different in some special cases. Those cases also we will discuss one by one. Now, why are we discussing period of holding? Because based on the period of holding only, we can differentiate an asset between a long-term capital asset and short-term capital asset. Sir, what is long-term capital asset? Kanna, long-term capital asset means any asset other than short-term capital asset. Then what is short-term capital asset? In short-term capital asset, you have three categories: 1 year category, 2 year category, and 3 year category. Sir, what is the 1 year category? 1 year category means any listed security other than units. Number two, units of equity oriented fund and UTI. It can be listed or unlisted, it does not matter. And number three, zero coupon bonds. So what are covered in 1 year category? Number one, listed security other than units. Number two, units of equity oriented fund and UTI, both listed as well as unlisted. And number three, zero coupon bonds. So for all these three types of asset, if the asset is held for up to 12 months, it will be called as short-term capital asset. If it is held for more than 12 months, it will be called as long-term capital asset. Now let us come to 24-month category or 2-year category. In this case, there are two items. Number one, unlisted shares. Unlisted shares. And number two, land or building or both. So in those two, that is unlisted shares and land or building or both, if it is held for up to 2 years, it will be called as short-term capital asset. If it is held for more than 2 years, it will be called as long-term capital asset. Now let's come to 36-month category. All the remaining capital assets will be covered under 36-month category, including units of debt-oriented fund and also unlisted securities other than shares. Okay. So all the capital assets that are other than 12-month and 24-month category will be covered in 36-month category. So if it is held up to 36 months, it will be called short term. More than 36 months, it will be called long term capital asset. And one more special point I told you, if at all a land and building are sold together, in that case, if the land is long term, then for that land alone calculate the long term capital gain. If the building is short term, then for building you can calculate short term capital gain, calculate separately. Okay. Then now comes the question, why are we discussing about period of holding? Why should we know whether an asset is a long term capital asset or short term capital asset? Answer is, there are two reasons, Kanna. First reason is the benefit of indexation is allowed only for long term capital asset, and second reason is that if the long term capital asset is transferred, then the capital gain or capital loss will be called long term capital gain or long term capital loss. If the short term capital asset is transferred, then the capital gain or loss will be called short term capital gain or short term capital loss. So firstly, let us discuss about indexation. I told you that long term capital asset will get the benefit of indexation. Now what is indexation? Indexation means finding out the cost of acquisition as on today's date for the asset which is acquired before. So if I have acquired an asset in 2005, the cost of acquisition should not be taken as the cost of acquisition of 2005. It should be taken as cost of acquisition as on 21-22. Okay, that is the previous year in which it is transferred. You get my point? So now how to do indexation? Very simple, Kana. Indexation can be done using the indexation table that is given by income tax law. Indexation table, in that each and every year will be mentioned, and for that the index number will be mentioned. With the help of that number you can find out the indexation. Should you memorize all the numbers? Answer is not required, but however indexation for 2001 2002 you have to memorize, and also indexation for the previous year which is applicable for your exam, that you have to memorize. Now for example 2001 2002 the index is 100, and for previous year 22-23 the index is 331. These two you memorize. All the other index numbers will be given in the question itself. Okay. Now how to find out the indexed cost of acquisition? Indexed cost of acquisition is equal to cost of acquisition multiplied by cost inflation index in the year of transfer divided by cost inflation index in the year which is first held, or cost inflation index of 2001 2002, whichever is later. Why are we taking whichever is later? Listen here. Now comes the special concept. Indexation starts only from 1/4/2001. Indexation starts only from 1/4/2001. Before 1/4/2001, there is no index number. That is why the assessee is having a benefit. What is the benefit? If at all any capital asset is purchased before 1/4/2001, then the assessee can take the cost of acquisition as the actual cost of acquisition or fair market value as on 1/4/2001, whichever is higher. So if an asset is acquired before 1/4/2001, then Cost of acquisition will be the fair market value as on 1/4/2001 or actual cost, whichever is higher. This higher value only you have to apply in the formula. This higher value only you have to apply in the formula while calculating the indexed cost of acquisition. So what is indexed cost of acquisition? Cost of acquisition multiplied by cost inflation index in the year of transfer divided by cost inflation index in the year of first held or cost inflation index in the year 2001 2002, whichever is later. Okay, then there is one or two special points about cost inflation index. That is, in case of a land or building or both, if fair market value as on 1/4/2001 is more than the stamp duty value, then take the stamp duty value. If fair market value is more than the stamp duty value, then don't take the fair market value, take the stamp duty value. In short, as on 1/4/2001, you can take fair market value or stamp duty value, whichever is lower. Then whichever is lower or actual cost, whichever is higher, can be taken as the cost of acquisition. Okay, and using this cost of acquisition, you find out the indexed value. Okay, next let's talk about improvement. Sir, what is improvement? Improvement means capital expenditure incurred on the capital asset. It will be called improvement. If any improvement is done before 1/4/2001, ignore it. If any improvement is done before 1/4/2001, ignore it. If it is done after 1/4/2001, then if it is a long-term capital asset, you should do indexation for the improvement. How to do the indexation? Indexed cost of acquisition is equal to cost of improvement is equal to cost of improvement multiplied by cost inflation index in the year of transfer divided by cost inflation index in the year of improvement. This is the formula for indexed cost of improvement. Hence, now you know about indexation. So what is indexation? Finding the value cost of acquisition of the asset in today's terms. It is called indexation. Indexation can be found out using the index values given by the income tax law. Okay. Now there are 4 cases where indexation will not apply even though it is a long-term capital asset. What are the 4 cases? Case number 1, section number 112A. In section 112A, indexation will not apply. Second, for bonds and debentures also indexation will not apply because the value of bonds and debenture does not increase over time. However, for capital indexation bond and sovereign gold bond, for these two bonds alone, you have to apply indexation. Next, if a non-resident is purchasing and selling the shares or debentures of an Indian company in foreign currency, then what you have to do? Then you have to calculate the capital gain also in foreign currency and then convert the capital gain into Indian currency and do not apply indexation. So what did I tell? If there is a non-resident who is purchasing and selling the shares of an Indian company or debentures of an Indian company in foreign currency, then find out the capital gain also in foreign currency and convert it later on into Indian currency, but don't do indexation. Okay, next in section number 50B, that is slump sale, also indexation concept will not apply. Indexation will not apply. So 4 cases where indexation will not apply. Number 1, 112A. Number 2, bonds and debentures other than capital indexation bond and sovereign gold bond. Number 3, if a non-resident is purchasing or selling the Indian shares or Indian debentures in foreign currency. And number 4, section 50B, that is slump sale. So in 4 cases indexation will not apply. Now we know the concept of indexation. Now let us discuss in detail the concept of cost of acquisition. So what is cost of acquisition, Karna? Very simple. Cost of acquisition means purchase price. Generally, cost of acquisition means what? Purchase price. Now let us discuss special cases of cost of acquisition. Firstly, let us discuss about intangible assets. So what are the intangible assets? Number 1, goodwill of business or profession. Number 2, trademark. Then right to manufacture, produce or process any article or thing, which is nothing but patent or copyright. Then right to carry on any business or profession, which is nothing but license, tenancy rights, stage carriage permits and lumars. Goodwill of business or profession, trademark, right to manufacture, produce or process any article or thing, right to carry on any business or profession, tenancy rights, stage carriage permits, that is the carriage permit from going from one state to another state given to a stage carriage. Okay, for example, a truck is having state permit, that is called stage carriage permit. And then lumars. Lumars means what? Handloom machine is given to people for using for n number of hours. It is called loom hours. So all these intangible asset, How to find out the cost of acquisition? Number one, if the intangible asset is purchased, then take the purchase cost. If it is purchased, then take the purchase cost. If it is self-generated, then take the cost as 0. If it is self-generated, take the cost as 0. And if it is other than purchase, it means if the intangible asset is received free of cost, if the intangible asset is received free of cost, then take the cost of previous owner. Okay, take cost of previous owner. And goodwill we already discussed in PGBP chapter, that now what has happened, goodwill depreciation will not be allowed from 1/4/2020 onwards. Hence, if goodwill of business or profession is there which was treated as depreciable asset till previous year 1920, then what will be the cost of acquisition of goodwill? Cost of acquisition will be purchase price of goodwill reduced by the depreciation that was claimed till previous year 1920. In short, the WDV as on 1/4/2020 will become the cost of acquisition, okay, for goodwill. Now, one special point is that for intangible asset, there is no benefit of fair market value as on 1/4/2001. So for intangible asset, even if the intangible asset is purchased before 1/4/2001, just take the purchase price. No need to consider the fair market value. And one more thing, if there is any intangible asset which is not covered in the list that we have mentioned in section number 55 now, then for such intangible asset, you cannot determine the cost of acquisition, and that is why the computation will fail and no capital gains will arise, as per BC Srinivasa Shetty case. So as per BC Srinivasa Shetty case, if there is any intangible asset on which cost of acquisition cannot be determined, then even the capital gains cannot be determined, and hence no capital gain will be taxable. Okay. So now we have discussed the intangible asset. One more point about intangible asset is that if there is any improvement in the intangible asset, cost of improvement, it means any capital expenditure is incurred for the intangible asset, then take the value of such improvement as 0. Always take the value of improvement as 0 for intangible assets. Okay, I hope you are clear. Now let's talk about the other capital assets. Firstly, for different points that I am going to discuss, I want you to know the concept. What is concept number 1? Concept number 1 is that if the assessee is receiving any asset free of cost and he does not pay any tax for it, then the cost of acquisition can be taken as the cost of the previous owner. Period of holding also take it from the previous owner. But indexation alone, there are two methods. For indexation, take it from the previous owner as per Manjula J. Shah case, or if you are following the Income Tax Act, you have to take it from the current owner. So what did I tell? If an assessee is receiving a capital asset free of cost and does not pay any tax for it, okay, in such case, cost of acquisition can be taken as cost of previous owner, period of holding can be taken from previous owner, but indexation should be taken from current owner. However, only in Manjula J. Shah case, you can take indexation also from the previous owner itself. Okay, I discussed also. Am I able to find? One second. See here. So, for example, if an asset is purchased in 2003 for 2 crore rupees, okay, listen here. Let's say a father is there. A father gave an asset to his son in 2018. That asset was purchased by the father in 2003 for 2 crores. Okay, the son got the asset free of cost from the father. Then the son has sold the asset to Mr. X in 2022 for 5 crore rupees. So now what will be the cost of acquisition in the hands of son? In the hands of son, cost of acquisition will be the cost of previous owner. That is the cost to his father. Hence it will be 2 crores. Cost of acquisition will be how much? 2 crores. Then what will be the period of holding? Period of holding also should be taken from the previous owner. That means from 2003 onwards till 2022 you have to take the period of holding. But what about indexation? In indexation there are two methods. Normal method, Manjula J. Shah case method. So what is the normal method? In normal method you have to take the cost of acquisition of previous owner, then multiplied by the cost of acquisition in the year of transfer, but divide it in the cost of acquisition of for cost inflation index in the year it which it is first held, that is 2018. So normal method is what? Take the 2 crores multiplied by 317, that is the cost inflation index in the year of transfer, divided by cost inflation index of 2018 and not 2003. This is the normal method. Means take cost inflation index from current owner. But there was a case in Bombay High Court which is applicable only to Maharashtra state, the case of Manjula Jesha. In Manjula Jesha case, what will happen? You have to take cost of acquisition from previous owner, okay, multiplied by cost inflation index in the year of transfer and divided by cost inflation index also from the previous owner itself, that is from 2003. So in Manjula Jesha case, cost inflation index will apply from previous owner, but in any other case it will apply from current owner. In your exams, which method you should apply? Answer is you are free to apply whatever method you want, but you should also mention that there is another method in the examination answer. My suggestion is to follow the normal method and put a note and write that alternatively even Manjula Jesha case method can be followed to calculate the indexed cost of acquisition. Okay. So next concept number 2. Concept number 2. What is concept number 2? If assessee's old asset is converted into new asset, then cost of the old asset will become the cost of acquisition of the new asset. Period of holding also should be taken from the old asset. Indexation also should be taken from the old asset. Okay. For example, preference shares converted into equity shares, etc. etc. Next, concept number 3. If assessee has paid the tax, okay, on income and he is getting an asset, in such case the value of that asset that was considered for the income calculation will become the cost of acquisition of that asset in the hands of assessee. If the assessee has paid the tax while receiving the asset, then the amount considered as value of asset while calculating the income will be taken as the cost of the acquisition. Period of holding and indexation should be taken from the day on which the assessee is receiving the asset. So for example, I gave you an example of ESOPs, correct? So when employee is receiving the ESOP, he will pay the tax under salary head of income as perquisites, correct? To calculate the perquisite, what was the fair market value of the shares that was taken will become the cost of acquisition of the shares in the hands of employee for future calculation. Similarly, under 56.210, that is for the gift if it is received for any inadequate consideration or no consideration, the value of the asset considered as fair market value while receiving the asset will become the cost of acquisition of that asset for future calculation. Okay. Similarly, if a stock is converted into capital asset, then on the fair market value of the stock, tax is paid under PGBP head of income. That is why the fair market value of such stock will become the cost of acquisition for capital gain purposes. You get my point? I hope you are clear. So concept number 4. If previous owner cannot be determined by the assessee, then what to do? In such case, take the fair market value on the date on which the asset became the property of the assessee, and from that day itself you start calculating the period of holding and indexation also. Okay. Now let us see the cases in the study material one by one so that you will become very clear. So see here, in all the cases that I am going to tell now, you have to take the cost of previous owner as per the concept. See here, distribution of assets on full or partial partition of HUF, then any gift or will that is received, any succession, inheritance or devolution, any distribution of assets on the liquidation of company, any transfer to a revocable or irrevocable asset, if any holding company is transferring to 100% Indian subsidiary, if any amalgamating company is transferring to amalgamated, demerged company transferring to resulting, and also if individual is converting his property into HUF property, in such case also the when the property comes in the hands of HUF, the cost of the property will be the cost of the previous owner. That is the cost of individual. Okay, conversion of individual of his separate property to HUF property. Then I told you about Manjula Jesha case. Now let us see the next case. Listen here. So in the scheme of amalgamation, when the old shares, that is the shares of amalgamating company, are converted into shares of amalgamated company, then cost of acquisition will be the cost of acquisition of the old shares. That is the cost of acquisition in the shares of amalgamating company. Now let's talk about conversion of bonds, debenture stock or deposit certificate into shares or debentures. In such case also, the cost of acquisition of the old shares will become the cost of acquisition of the new securities. Okay, old security will become the cost of acquisition of new security. Next, if there is any specified security or sweat equity shares. I already told you, cost of acquisition should be taken as fair market value which has been taken into account for perquisite calculation. Next, if any equity shares is received at the time of conversion of preference shares. So if preference shares is converted into equity shares, then cost of acquisition of the new equity shares will be the cost of acquisition of the preference shares. Okay. Next, if cost, what will be the cost of acquisition of shares received in resulting company in the scheme of demerger? See, I gave you an example, Nokana. See here, Titan Limited is there. Old Titan Limited, it is having two brands, that is Tanishq and Titan. So now Tanishq is coming out of Titan and forming a new company, Tanishq Limited, and balance will be called New Titan Limited. Okay, so from old Titan, two companies are coming out. New Titan and Tanishq. In such case, this is called demerger, correct? Now, how to find out the value of the Tanishq company shares, that is New Tanishq Limited shares. New Tanishq Limited shares value will be A multiplied by B divided by C. What is A multiplied by B divided by C? A is cost of acquisition of shares held in the demerged company. B is the net book value of assets transferred in demerger, and C will be the net worth of the demerged company. So in my given example, how to calculate the value of the new Tanishq company shares? It will be what? Cost of old Titan company shares multiplied by value of assets transferred to Tanishq divided by net worth of old Titan company shares or Titan company. So how to calculate the cost of new Tanishq shares? It will be cost of old Titan shares multiplied by value of asset transferred to Tanishq divided by net worth of old Titan. Net worth of old Titan. How to calculate the net worth? Net worth means aggregate of paid up share capital and general reserve. Aggregate of paid up share capital and general reserve. Now comes the question, what will be the value of new Titan shares? What will be the value of new Titan shares? Very simple. The value of old Titan shares minus value of the Tanishq company shares will be the value of new Titan shares. Very simple. Correct? I hope you are able to understand. Next, cost of acquisition of the property subject to tax under section 56(2)(10). So if already tax is paid under 56(2)(10), then the fair market value considered for 56(2)(10) will become the cost of the acquisition. Next, cost of acquisition in case of section 45(5)(a), that is joint development agreement. This we will discuss in joint development agreement concept itself. Next, this also I told you what will happen when capital asset which was used as inventory is converted into capital asset. When stock is converted into capital asset, what will happen? Fair market value on date of conversion will be treated as cost of acquisition of capital asset. Now let us see remaining points. Then we discussed about financial assets. So financial asset means what? The different types of securities. In case of financial asset, what will be the cost of acquisition? Very simple. Cost of acquisition will be the purchase price. Now let us talk about right shares. What is the right shares? I gave you an example in class. For example, Infosys Limited. Infosys company is there. It will give exclusive right to its old shareholders to buy the new shares, because if it is not giving the exclusive right, the shareholders will get very angry. So it will get the exclusive rights. So now when Infosys is giving me exclusive right, there are three options that can happen. Listen here. So let's say I am the shareholder. Infosys is giving me the right to buy the Infosys shares for 690 rupees. In such case, what I can do? Option number 1. I will give 690 rupees to Infosys and I will get the shares. Correct? This is called exercising the right. This is called what? Exercising the right. Next, I will not do anything at all, so my rights will lapse. It will get expired and nothing will happen. But generally, this will not happen because I am having option number 3. What is the option number 3? Option number 3 is called renouncement of right. Renouncement of right means what? This right I will give to some other person. Let's say I am having the right to buy the Infosys company shares. This right I am giving to Mr. X for 10 rupees. This right I am giving to Mr. X for 10 rupees. This is called renouncing the right. Now Mr. X will get the right from me and then he will pay 690 rupees to Infosys and he will get the Infosys company shares. So these are the three type of transaction. Now let us see what happens in this transaction. Firstly, If right is exercised, it means what? I am buying the Infosys company shares myself. In such case, the amount of 690 rupees paid to Infosys will be the cost of acquisition, and period of holding should be calculated from the date on which I am receiving the shares. That is from the date of allotment. Okay. Now what will happen when right is renounced? So when I have renounced my right, that is I have given my right to Mr. X, in such case cost of acquisition will be 0 because Infosys is giving me the right free of cost. Hence the cost will be 0. Selling price will be bought. Selling price will be 10 rupees. So the capital gain will be 10 rupees. Okay. And the period of holding should be calculated from the date on which Infosys has given me the offer till the date on which I am selling that right to some other person. Okay. Next, right acquired. Right acquired means what? When Mr. X is receiving the right from me, in such case, what will be the cost of acquisition? Answer is, cost of acquisition is the amount paid to the right seller. That is, in our example, it is 10 rupees. And then you should also include amount given to company, that is 690 rupees. So total cost will be how much? 700. So he is paying how much rupees? 700 rupees to get the Infosys company shares. 10 rupees he is paying me and 690 he is giving to Infosys company. So total 700. And what will be the period of holding? Period of holding should be taken from the date of allotment of the shares. Okay, this is the concept of right shares. Now let us discuss bonus shares. So bonus shares means what? The company is giving shares free of cost to the existing shareholders. Existing shareholders. I gave you an example. If Infosys is giving a bonus of 2:1, it means 2 bonus shares are given for every 1 share that is held by the assessee. If bonus shares are given before 1/4/2001, then take the fair market value on 1/4/2001 as the cost of acquisition. If the bonus share is received after 1/4/2001, on or after 1/4/2001, then cost of acquisition will be 0. Cost of acquisition will be how much? 0. Okay. For other capital asset, we have already discussed how to find out the cost of acquisition and cost of improvement. So now you know all about cost of acquisition, cost of improvement, full value of consideration, transfer expenses. So you will easily be able to find out the capital gains. Let us see one illustration quickly. See here. An asset is there, capital asset. It is purchased on 1/7/1996 for 50 lakh rupees. Improvement is done on 1/8/1999 for 10 lakh rupees. Another improvement is done on 1/9/2017 for 5 lakhs. Cost inflation index of 1718 is 272. Fair market value of capital asset as on 1/4/2001 is 70 lakhs. Capital asset is sold on 5th of June for 3 crores. Transfer expense is 1 lakh. So now how to calculate the capital gain? Firstly, take the full value of consideration. It is how much? 3 crore rupees. From that, you have to reduce the transfer expense. Transfer expense is how much? 1 lakh. After reducing, you will get the net consideration. Net consideration is how much? 2 crore 99 lakhs. From the net consideration, you have to see now whether the asset is a long-term capital asset or short-term capital asset. See, the asset was purchased in 1/7/1996. Hence, it is held for more than 3 years. Since the period of holding is more than 3 years, it is definitely a long-term capital asset. Since it's a long-term capital asset, indexation will apply. Now, you have to see whether the asset is purchased before 1/4/2001 or on or after 1/4/2001. If it is purchased before 1/4/2001, then the cost of acquisition of the asset will be the actual cost or fair market value as on 1/4/2001, whichever is higher. So what is the actual cost? Answer is 50 lakhs. What is the fair market value as on 1/4/2001? Answer is 70 lakhs. So whichever is higher, answer is 70 lakhs. So take 70 lakhs as the cost of acquisition. Now multiply it by the cost inflation index in the year of transfer. For previous year 21-22, the cost inflation index is 317 divided by cost inflation index in the year in which it is first held or 2001-2002, whichever is later. That is why we have taken cost inflation index of 2001-2002 as 100. Okay. So after doing this, you will find the indexed cost of acquisition. Next, let's find the indexed cost of improvement. Now what and all are the improvement? First see, improvement is done on 1/8/1999. Should you consider this improvement? Answer is no. You should not consider this improvement because if any improvement is done before 1/4/2001, you should ignore it because it is included in the fair market value of 70 lakhs. Okay, it is already included in this 70 lakhs, so you should ignore it. Now there is one more improvement done after 1/4/2001, which is what, 5 lakh rupees, done on 1/9/2017. For this you have to find indexed cost of improvement, which is what, take the value of improvement, multiply it by the cost inflation index in the year of transfer, and divide it by cost inflation index in the year of improvement. So you will find the indexed value of improvement. So reduce both of them, you will find the long-term capital gain. You get my point? It can be a loss also, and if it's a short-term asset, it will be called short-term capital gain. And if at all there is any 54 series exemption, that exemption benefit also can be availed by the assessee. So in this video, we had discussed the basics of capital gain calculation. All the points which is related to capital gain calculation are covered. The remaining special concepts, there are many special concepts in capital gain chapter, that we will be discussing in the next revision video, dear. So see you in the next one. Till then, take care. Bye bye.